Afternoon, ladies and gents. Simon Brown here doing the introduction for Warren Peacock this afternoon. But with that, Warren, over to you.
Thank you, Simon. Welcome, everybody. Today we're going to have a look at the first pattern in a short series we're doing. We're going to have a look at head and shoulders. It's probably the most spoken about chart pattern out there. Not necessarily the best performer, but it certainly ranks up there in the top 5. So let's start. Description of the head and shoulders pattern. Most importantly, please, it is a trend reversal pattern, which implies immediately that we need to have a trend. Very often this pattern is misunderstood in that respect. So people look at it, see a head and shoulders, and forget to check the prior trend, but I'll cover that a little later. There are 5 points of reference. The prior trend, the left shoulder, the head, the right shoulder, and the neckline. The ideal pattern would have the 2 shoulders at a similar price and the 2 neckline points at a similar price, as illustrated on the next slide. This is what would be considered perfect patterns. We have a bullish one on the left-hand side, and we can see the left shoulder and the right shoulder are at similar price levels, and the neckline is perfectly horizontal, and the head is below the 2 shoulders. On the bearish side, we've got it the other way around. Left shoulder, head, and right shoulder are pointing upwards with an almost perfectly horizontal neckline. And a break below that neckline constitutes a trigger. Now let's have a look at some real-life examples. The Fashini group had a really good head and shoulders pattern at the end of last year. Remember what I said to you, it's a trend reversal pattern. And check number 1, there's a trend to reverse. The next thing is that a resistance level has been broken. Don't worry, we'll draw all the lines in now. So here we go, checklist. First we confirm that there is a downtrend that can be reversed. Remember, this is a bullish head and shoulders. The neckline is even. We've got the top orange line there. The neckline is roughly the same price. The left and the right shoulders are also roughly the same price. One of the questions will be, do I use the wicks or do I use the bodies? Now, as far as I'm concerned, whichever one fits the best. So we can see on the neckline, for instance, we've got a spike, so just a price spike up there, but on the right side we've got the bodies. They fit really nicely. If that was a massive spike, these bodies would be more important. And we can see on the shoulders as well. We've got a spike over there on the left shoulder, we've got a spike on the right shoulder. We end up with angular trend lines which are pretty useless to us. So the bodies have worked out nicely, and that suits me just fine. Go and have a look. There are rules to chart patterns. I've tried to keep it as simple as possible without too much cloudiness, because you can make these things really complicated. The simple way to do this is, once the neckline is broken, you draw in your horizontal line. That's broken, that is an entry trigger. Now remember, this particular chart is end of day, so you've got the whole night to make up your mind what you want to do the next morning. We make sure that there's a downtrend, neckline was broken. That is my entry trigger. So the next day on open, or maybe in the first half hour of the day, if you can get a better price above the neckline, that's fine. Otherwise we can just enter at the open. The target is from the bottom of the head to the neckline. You can measure that in number of cents, so 100 cents for a rand, or you could say that distance there is 3%. You then measure that after the breakout. You then measure that height. So the distance from the bottom of the head to the neckline is the distance that we would expect the breakout to go. The stop loss is the bottom of the right shoulder. Now there's a couple of things here. Some people will trade the neckline as a stop loss. Personally, I don't like to do that. It doesn't give the market any space to confirm or follow through. The market does need momentum. We can see we already had 2 big candles for the breakout, which means we're most likely going to see a pullback. I'll just use the right shoulder as a stop loss area. The pattern usually is deemed failed once the price breaks lower than the head. Then it's no longer considered a head and shoulders pattern, but would be considered failed. The outcome of this particular pattern, you can see I've put it nicely here, left shoulder after a downtrend. Market then recovers slightly, finds some resistance, breaks lower than the left shoulder, finds some support, pulls back and essentially creates a double top. At the neckline, same price as the previous level, pulls back again, finds support on the right side at a similar level to the left-hand support, looking like a person's head and shoulders. Price breaks out. We put the extension, I've just put the box on here. That rectangle is simply time and price, and this particular pattern worked out really nicely. Time was identical, same number of candles between the breakout and the target being reached. The distance from the head to the neckline is the same height as this box, and this also illustrates the point where the price can pull back below the neckline, and a lot of people would be trying to escape the chart here. I think it's better to give it a little bit of space. Once again, if you trade with proper leverage, you wouldn't be too worried about it. You know, if you trade in the physical stocks, then again, that percentage can just be calculated, and make sure that you take the right number of shares for your risk analysis. The other thing to notice here was the stochastic confirming this particular pattern. It's oversold on the left shoulder. It goes overbought on the first half of the neckline, or would be considered the left armpit. Then the head goes oversold again. The right neckline goes overbought. And we have divergence on the right-hand shoulder. So every time the market bottomed out, the lows were slightly higher each time. Now that would be considered a confirmation pattern for this particular head and shoulders. It is not essential, it is just nice to see that. Bearish head and shoulders, again, the same idea. We have to confirm, in this case, an uptrend. So the market's run up, found a point of resistance, pulled back, found a point of support, broke higher again, found resistance, broke lower, and again the neckline is at a similar price. It doesn't necessarily have to be identical, but we do prefer, or I prefer them to be in a similar area. We can see the right shoulder as well. Left shoulder, right shoulder at similar prices. Measure the distance from the neckline to the head, and it will give you a lower target. Make sure that there has been a break below the neckline before you consider the trade. So that would be the entry trigger. And again, the right-hand shoulder gives us a stop-loss point. Like any other part of trading, you would use your money management rules to make sure that your position size is not too large or too small for your particular account. Measure the rand value, neckline to head, on the breakout, that would give you a target. The result of this trade will illustrate again that patience generally pays off. Now, with the chart pattern, the ideal is either it hits your target or it hits your stop loss. And we can see that RMH kept us busy for a good couple of months. There's 3 months in this trade. It gave us 3 little spike lows at the price targets. Once again, the boxes give us the price targets, and we can see it just spiked through there. If you had an order in, you may have been lucky enough to be filled and out of the trade. Eventually, by the end of May, it actually reached its target, and it broke through the lows at 39.32. This one illustrates the idea that the market doesn't always go in a straight line to exactly where we expect it to go. This is a longer trade, so if you were short, then patience would have paid off eventually. Make sure that you know where your stop losses are. Personally, I have not found it really viable to trail the stop on this thing unless the market has really moved a very long way, in other words, past its expected target. Only then do I consider trading my stop loss in the direction of the trend. So that was the result of RMH on the short. If you were maybe a share trader, I wouldn't call you an investor, maybe you've got a longer term portfolio, the head and shoulders pattern can be an idea to either hedge your position if you are willing to do that, or you would be closing out closing out those longer term trades on these reversal patterns, once again, only when the neckline is actually broken through. Now, those two were perfect examples. The necklines and the shoulders all tied up nicely. There are, however, variations like there are with any chart pattern, really. These two are particularly common for those of you that are trading intraday. So if you're day trading, let's say 5-minute chart, hourly chart, 4-hour chart, we're more likely to get one of these two variations. Either we get a widening pattern where the neckline begins to slope upwards, and on the other hand, we can have a narrowing pattern where the neckline squeezes lower towards the right-hand shoulder. And I've got here an Aussie 1-hour chart. This would be the upward sloping head and shoulders. Remember the checklist, it remains the same. Confirm the prior trend. Identify the support and resistance areas, so I've put little rectangles in there. Got the head at the bottom. We can see that the right neckline has gone higher than the left-hand neckline, and the right shoulder is also slightly higher than the left-hand shoulder. Draw the neckline in, identifying that it is an upward sloping neckline. In other words, it is widening away from the horizontal. This changes the entry point. So because it's sloping up, the longer that we wait for the breakout, as that trend line slopes up and up and up, the price is getting further and further and further away, and by that time you've actually, you could have missed anything 20, 25, maybe even 50% of the expected move. So what we do in this example is when the right armpit is actually broken, you can see it on the right hand side there, we use that as an entry trigger as opposed to the usual neckline trade. The stop loss remains below the right hand shoulder. Here's the result of the trade. Now this was just a couple of weeks ago. It was all over Twitter at the time. There's a head and shoulders reversal pattern on the Aussie hourly chart, and we can see downtrend, left shoulder, neckline, head, right neckline, and of course the shoulder. The market breaks out. Again, from the lowest point of the head to the neckline remains the target. So those blue lines are equal in size. That blue line is equal to that one. This particular pattern far exceeded the prediction that the pattern gave us. You can do one of two things. Either you can, once it gets through your target, you can trail your stop loss up, keep it tight, or you could simply just be target-based trading, put an exit order in, and take your profit at the expected target level. The next variation is a downward sloping head and shoulders. I used this particular one. There's always confusion with head and shoulder patterns. The most important thing is the idea that the shape of the chart gives us. The second important thing is there must be a prior trend. We can see here that there is a downward trend. It can be reversed. Left shoulder is formed, little neckline. Remember, this is a 4-hour chart on the Dow. The right neckline, downward sloping. The right shoulder becomes my stop loss. A close above that sloping neckline becomes an entry. Now, this particular trade didn't quite hit its targets. You can see that remember it's an index, so your trades are pretty quick. It's relatively easy to get filled and so on, but this pattern has not completed yet. This is a current chart. That last candle there was taken about 45 minutes ago or so. Hasn't hit its target. Now, this candle pattern here is called a shooting star. At resistance, that would certainly trigger an exit. Before that, we had here what would be called a double top, which we'll cover in the next series. Again, big candle breaks down, trailing stop should kick in on a break below that little support line. Again, with any trading tool, your judgment has to come into it. This is a good trade on the Dow. It's a good number of points. It's a bit of cash in the pocket. It's much simpler to just take the profit short of the ultimate target than holding on until to the very end, you know, trying to get that last cent out of your trade, rather leave a little bit for somebody else. In summary, so this would be your checklist. Identify the trend. No prior trend, no head and shoulders pattern. It will look like a head and shoulders. You could call it a head and shoulders, but it's not tradable. The even and the narrowing patterns, we use the break and close above or below the neckline as an entry trigger. The target is based on the distance between the head and the neckline being placed on the breakout area. So where the candle breaks, that would be your, you can put your target on there, and we extend that into the future price-wise. The widening pattern uses a break and close above or below the right armpit as an entry trigger, as opposed to the neckline. The target is also based then on the distance between the head and the neckline being placed on the right armpit and extended into the future. That brings me to the end of the pattern itself. Please, you guys are welcome to contact me. There's my email address and phone number if you do need to ask any questions after the webinar.
Thanks, Warren. A couple of questions coming in. First question, what are the top 5 patterns? You referred to that right up front, head and shoulders, one of them. What are the top 5 patterns?
The top 2 are considered to be the flag and pennant. They have pretty much got the highest hit rates. In other words, they fulfill their criteria more often. Then, because the head and shoulders is both a bullish and a bearish pattern, the bearish one has a better hit rate than the bullish one, which I do find rather strange, and I haven't really gone and studied this myself. It's just basically what I've been reading about, and then the triangles come in there as well.
Cool. And if you go to just one lap, you'll find more on the pennant. Warren's done that before. Question coming through Mikey asks, do you need a number of shares before taking a short position? Mikey would use a derivative in order to take a short position running through. Luis is asking about using a markup tool to highlight where we're on the screen. We hear you, and in fact, Warren and I were talking about the lack of whiteboard and the like. It's something which we're going to investigate and dig around in that space. Folks who got questions, drop them in the Q&A box. There's a couple still coming through. Another question, Warren, and there's a few here which I'm going to kind of merge into the one. Entry and exit. Entry is a break of the neckline. Your sell target is on the height of the head and shoulders above that. What do you use for stop loss?
The bottom of the right shoulder on a bullish pattern, or the top of the right shoulder on a bearish pattern.
Okay, so use the shoulders on the patterns there for it.
Yeah.
Cool, noted there. Question, would one still use a 2% rule or a risk management rule in this? I'm going to jump in and say absolutely, you always want to have your risk management, regardless what or how you're trading, you always want that 2% rule.
Absolutely.
And then, folks, I'm not seeing any more questions coming through, so there are some more coming in. Sorry, okay, so suddenly here come a bunch of them. Brian saying rough hit ratio on this trade. Warren, do you have, I mean, I've heard numbers around the sort of 60% for head and shoulders.
According to Bulkowski, who, he's studied these chart patterns for years, and he's got a whole website on the probabilities. On a bullish head and shoulders, he's got a 74% of the time it will reach its target, and on the bearish one, it's closer to 80% of the time it'll hit its target. But that is only after it's broken the neckline. Okay,
and those are quite massive numbers there.
That's big, yeah.
Yeah, no, absolutely. David, yes, you can. That's not a problem. Another one mentioned trading a failed head and shoulders. What Paul's asking here, and I've heard the discussion before. So if you've got a head and shoulders, let's say a bullish, so it's reversal going upwards, if it fails, can you trade that fail by taking a short? In other words, the neckline essentially acts as a resistance.
Personally, I've never done that. The whole thing with this particular chart pattern is the lack of momentum in the first place. So once we start using neckline as a failure point, we can then no longer use the right shoulder as a stop loss. So the pattern really is only failed if it breaks below the head. Once it's done that can be quite a large percentage move already, and I don't see the probability of a follow-through. When it comes to things like pennants and triangles, there's normally quite a lot of space for retracement. The head and shoulders, from what I've seen, especially on the bullish side, if it fails, there's not a lot of downside left to it really. Whereas if it's a bearish head and shoulders that fails, in other words, it breaks through resistance, then you could probably consider a long, but I certainly wouldn't be shorting on a failed bullish head and shoulders.
Gotcha. That makes a whole lot of sense. Jonathan, you're asking, do you trade CFDs in this patterns? One can do either CFDs, you could trade the equity, you could trade a single stock future. In one example there, Warren was looking at Aussie futures as well. You can trade pretty much anything on it. And whether you trade it geared or ungeared, with derivatives or not, is going to be a personal preference in that place, in that sense. Ladies and gents, we've got time on our side, but I certainly see that questions have been drying up, so we'll leave it there. My thanks to Warren. The video will be up tomorrow morning, that being Wednesday, and of course we'll have Warren again and be back early August with more of these. Warren, really appreciate the time. Ladies and gents, thanks very much.
Thank you, Simon. Cheers, everyone.